So risk management, question number 1. In question number 1 on risk management, we have a portfolio comprising of 2 stocks ABC, XYZ. We are given the investment in the 2 shares 200 lakh, 200 lakh. Standard deviation daily is also same 1% and correlation between them is 0.3. Question says calculate the 10-day 99% VAR and we are given the Z score at 99% is 2.33. It is said show your calculations up to 4 decimal points. So how you should do the sum? First of all, calculate the standard deviation of each stock in rupee terms. So 200 lakh into 1% is what? 2 lakhs. That is the standard deviation in rupee terms. So 2 lakh for stock ABC, 2 lakh for stock XYZ. Now apply the Markowitz formula for SD of the portfolio. So SD of the portfolio is square root 2 square plus 2 square plus 2 into 0.3 into 2 into 2. I mean to say variance of ABC plus variance of XYZ plus 2 into correlation into SD of ABC into SD of XYZ. I repeat, variance of ABC, that means 2 square, plus variance of XYZ, that is 2 square, plus 2 into correlation, that is 0.3 into SD2 into SD2. Okay, now somebody may be confused that sir, we apply the formula weight square into variance plus weight square into variance plus 2 into weight into covariance. Why are you not taking the weights? Now what is the importance of weight? The importance of weight is that the amount which is invested in the 2 stock, that is used to find out the weights. Now we have already used the amount now because we have calculated the SD in amount terms, 200 lakhs into 1%. So the effect of the weights has gone into it. So can we do it weight square and all that? You can do it in a normal checking, but in CA Institute checking you can't do, because when he will find that your answers will not match, because you will compute, for example, the weights are half. So I can do 0.5 square into 1 square plus 0.5 square into 1 square plus 2 into 0.5 into 0.5 into 0.3 into 1 into 1. That's SD of the portfolio in percentage. But they will not accept the solution, I know it. So it's better to know what they have done. So calculate the SD in amount, which is 2 lakh, and then SD of portfolio is 2 square plus 2 square plus 2 into 0.3 into 2 into 2. So what if next time investment in ABC is 300 lakh, investment in XYZ is 200 lakh, no issues. In that case, the SD of ABC will be 300 lakh into 1%, that is 3 lakh. SD of XYZ will be 2 lakh. So 3 square plus 2 square plus 2 into 0.3 into 3 into 2. So what if the standard deviation of both the stocks are different? No issues. Suppose the standard deviation of first stock is 1%, standard deviation of the second stock is 2%. You calculate the first stock, say 300 lakh, 1% is 3 lakh. For second stock, 200 lakh, 2% is 4 lakh. So 3 square plus 4 square plus 2 into 0.3 into 3 into 4 square root. Understood? There is no question of any confusion. So you have computed the SD of the portfolio in rupee terms. Now we are supposed to calculate the 10-day 99% VAR. So we don't want a 1-day SD, we want a 10-day SD. You know the square root rule. If 1-day SD is known, the 10-day SD is 1-day SD into square root of 10. 1-day SD into square root of 10. So you get the 10-day SD. But if you have to calculate 99% VAR at a 99% confidence, so Z is 2.33. So VAR is 2.33 into 10 day SD. 2.33 into 10 day SD. Okay, please understand, VAR is scaled volatility. VAR is what? VAR is standard deviation, but not standard deviation at 1Z. It is standard deviation at the Z corresponding to the level of confidence. And then you can interpret that this is the maximum possible loss, okay, under normal circumstances with a 1% chance of being exceeded.
Question number 2, as I said. Okay, although question number 2 was marked as new, but I remember this is an old sum. This is an old sum, but it's a good sum because it involves valuation and many calculations. So if somebody does the sum, that person is able to get a hold over mergers quite nicely. Okay, let's do the sum. TK and SK are both in the same industry. Okay, same industry. There's lower risk in the merger. Former is in negotiation for acquisition of the latter. So TK is the acquiring firm. I'll call it A Limited. SK is the target firm, B Limited. Information about the two companies as per their latest financial statements are given below. Okay, here is the information, TK and SK. So number of shares of rupees 10 face value, 24 lakh, 12 lakhs. Debt. Okay, for TK Limited we have 10% debentures, 1160 lakhs. For SK Limited we have 12.5% institutional loan of 480 lakhs. EBITDA, earning before interest and depreciation, amortization and tax, 800 lakhs to 30 lakhs, EBITDA. Actually in the sum, depreciation is not given. They should have given EBIT over here because we are forced to assume that depreciation is nil. And how is it possible that depreciation is nil? So don't ask me that doubt. So I feel that they should have given EBIT to us so that that presumption would not have come. Market price is 220 for TK and 110 for SK. TK Limited plans to offer price for SK business as a whole, which will be 7 times EBITDA as reduced by outstanding debt. Okay, so what is TK going to offer to SK? 7 times EBITDA. EBITDA is 230. So I'm taking the calculator. 230 into 7. That's coming to 1610 lakhs. reduced by outstanding debt, because 1610 lakhs is the value of the firm. Okay, because we took the EBITDA. EBITDA belongs to the firm, equity and debt both. So 7 times EBITDA is the value of the firm. We deduct debt minus 480. Okay, so 1130 lakhs is the purchase consideration. 1130 lakhs is the purchase consideration. I don't think you mind the fact that, sir, you are not writing. How does it matter? 7 times EBITDA, 7 into 480. Okay, and reduced by debt minus 7 into 230. Reduced by debt means minus 480. That comes to 1130 lakhs. Discharged by own shares at market price. So we will issue our own shares at market price. What is our market price? 220. So if I have to pay 1130 lakhs, okay, in the form of shares worth 220, number of shares will be equal to 1130 divided by 220. 1130 lakhs divided by 220, that is 5.14 lakhs. Okay, 5.14 lakhs is the number of shares. 5.14 lakhs. SK Limited, the target firm, is planning to seek 1 share for every 2 shares based on the market price. Because see, the market price of SK is 110, while the market price of the acquirer is 220. So 110 by 220, half is the exchange ratio. So they want 1 share for every 2 shares held, the target company. Tax rate is 30%. Calculate and show the following under both the alternatives. There are 2 alternatives, not TK Limited's offer and SK Limited offer. We have to calculate all this. So in the TK Limited offer, let me concentrate on the first offer. The net consideration payable was, we calculated that to be 1130 lakhs. You remember 7 times EBITDA, so 7 into 230, reduced by debt minus 480, that's 1130 lakhs. Number of shares to be issued is 1130 lakhs divided by 220, which is approximately 5.14 lakhs. EPS of TK Limited after acquisition. So for this purpose, we have to find out the PAT of both the firms. We are given the EBITDA. So we need to deduct depreciation, interest, amortization and tax. But depreciation, amortization are not given. So forget about it. So we just deduct interest and make it post-tax. So for TK Limited, 800 minus 10% of 1160. Can you see that? The ventures is 1160. So 10% of 1160, 116. So 800 minus 116, I'm doing it. 800 minus 116. That's the PBT, and that into 0.7, because 30 is the post-tax, 30 is the tax rate, into 0.7. So that comes to 478 lakhs. 478 lakhs is the profit of TK, profit after tax. Same thing for SK. This time, the EBITDA is 230. We have to reduce the interest on institutional loan, 12.5% of 480. So let me do that. 230 minus 0.125 into 480. That comes to 170 lakhs, and 170 into 0.7 is equal to 119 lakhs. So 119 lakhs is the PAT of firm B. If I add both the PATs, the PAT of firm A was 478.8 plus the PAT of firm B is 119 something. So we get 597.8 lakhs. So 597.8 lakhs will be the total earnings of the combined firm, because it's not written that earnings will go up. Okay, 597.18 will be the earnings of the combined firm, and number of shares will be the 24 lakh shares of TK plus the 5.14 lakhs issued to SK. So 24 plus 5.14, that's approximately 29.14 lakh shares. 29.14 lakh shares. So if I divide the combined earnings, which is 597.8, divided by the combined number of shares, which is 29.14, I get 20.51. 20.51. 20.51. Let me check the answers. 1130, 5.4 lakh shares, and 20.91. It's 20.51. They're getting 20.52 because I rounded up the shares to 5.14. It's 5,13,600 shares. Okay, that are issued to SK. Perfect. Fourth part, expected market price after acquisition. P ratio. So we got the EPS 20.52, and we should multiply by the P ratio, bootstrap effect, which I said just 5 minutes ago. So we have to find out the P ratio of TK. The price of TK is given 220. We need the EPS. So what was the PAT I got for TK? The PAT I got for TK was 478.8 lakhs, and the number of shares is 24 lakhs divided by 24. Okay, so 19.95 is the EPS of TK, 19.95. So 220 divided by the EPS of 19.95. P ratio is 11.03 times. 11.03 times. So 11.03 shall be the P ratio after merger bootstrap effect, and that into the EPS, which we got that time 20.52. So 226.29 expected share price, 226.29. Expected share price, 226.34 expected share price. Okay, post merger EPS into P ratio bootstrap. Last part, straight briefly the advantages to TK from the acquisition. Now this is a merger of two firms in the same industry. So on the revenue side, there will be avoidance of competition, greater market share, greater monopoly power, okay, pricing power, and on the cost side there will be cost reduction due to economies of scale and better coordination. Economies of scale and better coordination. So that's the theory question. So that was one part. We computed all this based on what TK Limited wants to pay to SK. Now let's come to what SK wants. So it's written SK wants 1 share for every 2 shares held. SK wants 1 share for every 2 shares held. So that means exchange ratio is 0.5. So number of shares to be issued will be 12 lakh into 0.5. That is 6 lakh. Can you see that? 12 lakh into 0.5, 6 lakhs. So total number of shares will be 24 plus 6, 30 lakhs. 24 plus 6 equal to 30 lakhs. That is the total number of shares. 30 lakhs. Okay, 30 lakhs is the total number of shares. They are asking us to calculate the net consideration payable. So we are giving them 6 lakh shares and the share price is what? 220. So the net consideration payable is 6 into 220, which is 1320 lakhs. 1320 lakhs. So question number 1, net consideration payable 6 lakh shares at 220. 1320 lakhs. Number of shares to be issued 12 lakhs into 0.5, 6 lakhs. Okay. So we got 2 answers, 1320 and 6 lakhs. Let's check. Yeah, 1320 and 6 lakhs. Next part. What is the EPS of TK after acquisition? So we got the combined PAT at that time. I think the combined PAT was 597.8 lakhs. Okay. So that divided by the combined number of shares, which is 30, divided by 30. So this gives me an EPS of 19.93. EPS of 19.93, is it? Yeah, 19.93, perfect. Then they're asking, what's the share price? So that into P ratio. P ratio was 11.03 into 11.03 equal to 219.79. 219.79, yes, 219.23. That's the answer, market price. So it's a very, very simple question. But sometimes what happens, I've seen with many students in the exam, is that they can't do the simple sums. They do some silly mistakes and then they are asking for part marks. This is a very, very simple sum. You should be doing it exactly correct, and I am 100% sure you are not minding that I am doing it verbally, because you should also be doing that way. Now you have your calci and the pen ready. Why don't you do it this way? Correct? And if you want the written solution, it's given in a decorated manner by the institute. Let's read the question. Question number 12. Messrs. Sky Products Limited of Mumbai, an exporter of seafoods, has submitted a 60-day bill for Euro 5 lakh drawn under an irrevocable letter of credit for negotiation. Now, rather than trying to be so much heavied by the statement irrevocable negotiation, okay, you should focus that it's an Indian exporter. So if an Indian exporter, it has a foreign currency receivable. What is the receivable? 5 lakh. What is the days? 60 days bill. So the simple concept is, okay, after 60 days we are going to receive 5 lakh, it seems. The company has desired to keep 50% of the bill amount under the exchange earners foreign currency account. So they don't want to convert 2,50,000. They only want to convert the remaining 2,50,000. They don't want to convert 5 lakh. They only want to convert 2,50,000. Okay, the remaining shall remain over there. The rate for rupee per dollar and USD per euro in the interbank market are quoted as follows. So rupee per dollar and dollar per euro, if you multiply rupee per dollar into dollar per euro, you will get rupee per euro. That's bacha stuff. Rupee per dollar into dollar per euro shall be what? Rupee per euro. Okay. Yeah, somebody saying that it's similar to bill discounting, correct. Okay, but the way CA Institute has done it, it is stupidity. The solution that has been done, it will hurt our brains, but we have to. Can't help. So we are given the spot rate, rupee per dollar, dollar per euro. We are prepared to multiply them, and we are given the 1 month, 2 month, 3 month rate. Remember, we want the rupee per euro rate and the bid rate. So bid into bid is bid. Okay, bid into bid is bid. Okay, the 2 bid rates. So we are given the 1 month rate, 2 month rate, 3 month rate. It seems like we should use the 2 month rate because 60 days bill. Transit period is 20 days. I said there's another period. So the 60 days is the issuance period. This 20 days is the transit period. So 60 plus 20 is 80. Okay. Whenever you have such a sum, where you have the issuance period and the transit period, you add the two up, total period, and you always do a lower rounding off for the purpose of finding out the exchange rate. You don't find out the 80-day forward rate, okay, by unitary method. You have to do a lower rounding off to find out the rate. So here, what is the lower rounding off? Is it 60 or is it 90? What is the forward rate? Is it 60 or is it 90? Is it 60 or is it 90? So some people like Komal are quoting sites, page number this, sum number this in our book. So Komal, you might have done the sum, but I don't remember having done this in the English batch. So the lower rounding off, I didn't say closer rounding off. I said lower rounding off is 60. I didn't say closer rounding off. I said lower rounding off. So 80 is rounded off to 60. Now you have to know this. This is something which cannot come conceptually in the exam hall. It has to be done from home. Okay, it is as per FIDI guidelines. So 60 days rounding off. So and the exchange margin is 0.1%. So, exchange margin shall be deducted because the customer has to suffer. The customer is selling euro, he'll be quoted the bid into bid rate less 0.1%. So, rupee per dollar, the bid rate is 67.8 thousand minus 0.0021. No, I am really confused because it's written 21 paise, so it should be 0.21. So 67.8 minus 0.21 is what I think it should be. Okay, 67.8 minus 0.21. I don't know whether they'll do 0.0021 because it's clearly written paise. If 21 is paise, it's 0.21 rupees. Na? There is no question of dividing by 10,000. So I think it should be 67.8 minus 0.21, but I keep my fingers crossed. So you don't know the answer? No, I'm not mugging up and coming for the answer. I don't have lack in life. There are other things. The market is there for me to see. When we see the USD per euro rate, we have 1.0775, and why did I do minus? It will be plus now. 21.28 is low high plus. I'm sorry. So 67.8 plus 0.21. Sorry, I said minus. 67.8 plus 0.21. 67.8 plus 0.21. Okay, or plus 0.0021. Logically, it should be plus 0.21. And over here we have 4 decimal places. So 1.0775. It should be plus 0.0040. 1.0775. It should be plus 0.0040. Okay, plus 0.0040. This is my gut. It should be this way, and then we should multiply both the rates. Multiply both the rates and then deduct 0.1%. Multiply both the rates, then deduct 0.1%. Okay, so they're asking us. Interest on post shipment rate is 8%. That's a different thing. They will charge interest on the loan provided today. Exchange margin 0.1%. Assume 365 days in a year. Find out the exchange rate quoted to the company. So the exchange rate shall be the 60-day rate, the lower rounding of rate, 60-day rate, which is bid into bid minus the margin. Let's look at the solution. If you look at the solution, the institute has written transit plus usefulness 80 days rounded up to the lower number of months. So forward bid rate has to be taken the 60 day. So 67.8 plus 0.21, correct? Okay, 68.01. They have done the margin deduction over there only. They could have done it later on. It doesn't matter. The answer will be same. If they do later on, because if you do A into B and then multiplied by C, or you do A into C multiplied by B, it's the same thing now. So even if you deduct the margin 0.1% later, the answer will be same. The answer will be same. I'm not talking about decimal place fight, but it's simple maths. Okay. I mean to say this is really going to cause confusion. If I do bid rate into bid rate and then I take 99.99%, or if I do bid rate and take 99.99%, whatever I get, and then I do into another bid rate. Look at the same. The maths is same. Can you see this? Can you see this, please? I hope you can see this. So whether I deduct the 0.1% after calculating the cross rate, or I deduct it from the rupee per dollar rate and then multiply it with the dollar per euro rate, the answer will be same, of course subject to rounding off differences. What is good from CA Institute examination point of view is to know everything, to be very, very knowledgeable, but at the same time to be humble. And to understand that ICAI is the BAP of the BAP of the BAP of the BAP. Sanjay Saraf is nothing. Whatever ICAI does is correct. So we should try to adapt. So if I were sitting for the examination, I will keep my head very high as far as knowledge is concerned. But I will try to look at the ICAI solution and try to adjust myself towards that, because I need to get the best of marks. So I would do the way Institute has done. And I would mold myself by looking at a number of sums. When you see a number of sums, you understand the way they are doing it. Okay. So you tend to understand that. It can be frustrating for some people who are like very conceptual. No sir, this way I can't remember. Okay, so in that case maybe it's a wrong course that you have joined, but this is the reality. Okay, this is a fact, and it doesn't only happen in SFM, it happens in other subjects also. It's just that in SFM you expect an extra degree of perfection. So they have done 68.01 less 0.1% margin and 1.0775 USD euro, and then add premium 0.0040. So nobody can say, sir, in 21 they did 0.21, but regarding 40 they did 0.4. No, they did 0.0040 because 21 was paise. Okay, so it was like divided by 100 rupees. The other rate was in 4 decimal places, so it was divided by 10,000. Okay, you have to be smart. I think that's the most important thing in this question. This was the most important thing in this question. I've already explained, Pranav. When the rates are given in 4 decimal places, then the swap points are to be divided by 10,000. Okay. Some common sense is also there, and if you want to fight, you can keep on fighting, and the best is you can mail to the examination department of the ICAI. Okay, or you can adapt to what I'm trying to say. So my explanation is that the rate 67.8 is a big rate. 21 paise is a small amount, 0.21. We don't have, I don't know, paise upon 100 is called what's up paise. Okay, but the rate 1.0775 is a 1.0775. The 0.07 is big. If you do an adjustment of 0.4, that becomes 1.47. An exchange rate of 1.07 cannot become 1.47 in 2-month period. It doesn't happen. If you have common sense, an exchange rate of 1.07 does not become 1.47 even in a year. 50% appreciation or depreciation does not take place. That's the biggest common sense that's there. If you get it, fine. And if you're after the cents and paise, it is as your conscience allows you to do. Okay. Whenever is not the thing, it's a question of common sense. 1.07 cannot become 1.47. If you got it, well and good. If you didn't get it, it's unfortunate. So that is 1.0775 plus 0.0040 because 1.47 is not allowed. It's a 50% appreciation, whereas 67.8.21 is very perfect. So that's the exchange rate to be quoted. Cash inflow to the company. So whatever rate you got, that multiplied by whatever rate we got, that multiplied by the amount which was 2,50,000, not 5 lakh, because we did not want to convert the remaining 2,50,000. We only wanted to convert the 2,50,000. So 2,50,000 multiplied by the rate in the first part shall be the cash inflow to the company. Interest amount to be paid to the bank by the company. So interest amount shall be for 80 days. Interest amount shall not be for 60 days. Interest amount shall be for 80 days. So you calculate interest for 80 days. Okay, at the rate of 8%. Interest for 80 days at the rate of 8%. So this is once again the sum that shocked people. The NDF sum also shocked people, and this sum also shocked people. This is the reason why these classes are happening. It is not happening for all the 39 sums that have been given. Many of the 39 sums which are given in Forex, I have done it in the class. In the class means the English batch. I'm not talking about the revision classes and the challenges series and the new marathon. Okay, I'm talking about the English batch itself. If you check out in your copy, okay, there were sums which are included in the 39 sums which I consider very important, and I've taken it again, but which are already done by us in the English batch. Okay. Anyways, so this is that sum. There's a huge confusion about 0.21 and 0.0040. Believe me, if you think conceptually about it, 67.8 a big figure, 0.21 is perfect for that. 1.07 is a small figure. We can't have 0.4 added to it. Okay, it will shock the rate. That cannot happen. Okay, so you have to also be mindful about that. Now, why did I say that the solution is completely wrong? Let's talk common sense about it. In real life, if you are listening to me properly, negotiation of a bill always takes place at the spot rate. Negotiation of a bill takes place at the spot rate. I mean to this, a spot rate is 67.8 into 1.0775. Can you see that? 67.8. People are not listening now. They are keeping on writing their own stuff because they want to become typing champion. Please continue. 67.8 into 1.0775. At that rate, 2,50,000 is converted because that's the loan amount. That is the only logic why we are keeping the remaining 50% in the exchange earners foreign currency account, because there we expect an appreciation will take place in dollar and we'll be able to sell it at a higher rate. Why would the bank convert the amount at the forward rate and give us the loan today? It doesn't happen this way. So if you have any bank audit, you might be having some officers who are working in the export-import division of the bank, even the scheduled commercial Indian banks, Bank of Baroda and all that, and you can ask them, they will tell you negotiation of the bill does not take place at the forward rate. It takes place at the spot rate. At the spot rate. So the answer is completely wrong. Secondly, transit period is not associated with a issuance bill. Transit period is associated with a sight bill. You must be knowing what a sight bill is. You must have done it in law. Can I have the knowledge from you? What is a sight bill? What is a sight bill? What is a sight bill? A sight bill does not have a period. There is no 60 days. It's just payment on sight. Okay, there is no 60-day period over there. There we have the concept of transit period as per FIDI. And the minimum transit period as per FIDI is 25 days. It's not even 20 days what's written over here. For some Scandinavian countries, RBI, FIDI allows a higher transit period up to 90 days. If you look at the FIDI guidelines, you can have a look at it by Googling after the class today. So transit period doesn't happen with the issuance bill. It is actually stupidity that we have a transit period with the issuance bill, because the 60 days already incorporates the 20 days. The 60 days incorporates the 20 days. So there is too much stupidity in the question in the solution, which actually defies all practicality. And I request you that if you have references, you can verify it with your references that how does it happen in real life. So I may not go into it. A student is writing, why didn't you apply the margin on the USD per euro exchange rate? So are you going to apply the margin twice? Then 0.1% first deducted from rupee per USD, then 0.1% deducted from dollar per euro. Have you lost it? The margin is to be deducted once. My style in class was to find out the cross rate, then deduct it. They have deducted from one particular rate, rupee per dollar, then multiplied by the dollar per euro rate. Both should give the same answer, subject to rounding of differences. I explained that very clearly. Bank BK enters into a repo for 9 days with Bank NE in 6% government bond 2022 for an amount of 2 crores. So 2 crore is the face value of the security sold. It's a 9 days repo. Okay, and 6% is the coupon. The other details are first leg 2 crore 6,750. So they've already calculated everything. Yeah, you understanding? 2 crore at a certain clean price. I don't know how much. Then accrued interest was added. Accrued interest, they've written days of accrued interest 240. So 240 days 6% was added to that clean price. And then initial margin 1.25% was deducted. So this 200,06750 is arrived by adding accrued interest to the clean price and deducting the 1.25% initial margin. Please understand. Okay. Second leg also is given. So after this 2,6750, interest has to be paid, okay, for 9 days, and that entire thing comes to 2,0031759. So I've seen the first one of this type where both the first leg, second leg are given. So it's some on back calculation. They're asking us to take 360 days in a year. You are required to calculate the repo rate. Okay, repo rate is like you have taken a loan of 2,6750, repaid 2,31759. What is the interest rate? The interest rate is the difference divided by the loan amount 2,000,6750 into 360 divided by 9. This is the easiest thing in the world. The loan amount is 2,6750. The repayment amount is 2,31,759. So what is the interest rate? It is the difference divided by the loan amount 2,6750 into 100 into 360 divided by 9. I hope you're understanding. I don't have to write into it, but you never know what happens when we are stressed out. So let me just solve it. I'm finding it very odd to solve. Interest rate, the repo rate, is equal to the repayment amount 2 crore 31,759. 31,759 minus the loan amount 2 crore 6,750. Divide by the loan amount. You have to be taught that you have to divide by the loan amount every time it happens, and it's into 100. So this is for 9 days. So annual is into 360 by 9. Yeah, what is the answer? The answer is 5% is the answer. That's the repo rate, 5%. You know, as a part of COVID, Reserve Bank of India went on deducting the repo rate. Otherwise, repo rate used to be higher, 6.5%. Okay, 5% is the repo rate over here. The second question that they're asking is calculate the dirty price. So the loan amount 2 crore 6,750 was the clean price plus accrued interest dirty price less 1.25%. So this 2,000,6750 is 98.75%. It's after deducting the initial margin. Are you getting me? Dirty price into 98.75% is the 2 crore 6,750. So what is the dirty price? So this 2 crore 6,750, okay, 2,000,6750 divided by 0.9875. 2,000,6750 divided by 0.9875. This is 20260. 1 second. 20260,000. Now, but when they ask for the dirty price, they ask it in terms of per 100 of face value. This is for a face value of 2 crore. So for dirty price per 100 of face value, per 100 of face value is equal to this divided by 2 crore into 100. Yeah, common sense. What does it come to? It's coming to 101.3. Okay, so you have to calculate it as per 100. So 101.3 is the dirty price. Okay, dirty price 101.3. Now, clean price. So clean price is 101.3. The dirty price is clean price plus accrued interest. So we have to remove the accrued interest for 240 days at the rate of 6%. Let's do it. So accrued interest based on 100 is 6% of 100 into 240 by 360. I'm calculating the accrued interest. 6% of 100 into 240 by 360 is 4 rupees. So 4 rupees is included over there. So clean price is the dirty price minus the accrued interest. So 101.3 minus 4 is equal to 97.3 answer, clean price. So in this sum, calculate EVA. They have calculated EVA as EBIT, the 800 minus the tax amount 231. Whereas we do 800 into 1 minus T, but they have done 800 minus 231. In fact, in adjustment number 4, it's given bad debt provision of 40 lakhs is included in indirect expense and 40 lakhs reduced from receivables. So they've added 40 lakhs because it's non-cash. So 800 plus 40, 840 minus 231. What is it coming to? NOPAT in this sum is 800 plus 40 minus 231, 609. Sir, do we have to remember this? Yes, we have to remember this. Sir, can't we do the correct solution and then write a note? No, you can't do the correct solution. Correct is what is correct as per ICI. 800 plus 40 minus 231, 609. That's the NOPAT. And then the capital employed over here, you can find net worth is 1000 plus 600, 1600, and long-term borrowing 200. So 1800 is the capital employed, but because 40, the bad debt provision will be added back to debtors. So therefore the capital employed is 1840. Capital employed is 1840. Okay, 1840. Now, to calculate the cost of capital, they have ignored the 40. They have taken the cost of capital based on 1600 and 200. So you have to remember that although they added 40 to the capital employed, but then while calculating cost of capital, they forgot the 40 and they took it on the basis of 1600 and 200. So I don't like all this frustration. I can't help. Okay, I can't help. I am concerned with guiding you on how to get the best of marks while giving knowledge which was given in class. Perfect. So this was the wrong sum on EVA which is done in class. Okay, so very important sum. It can come in the exam again. Do not apply a concept. Apply what institute has done. Next. Let me now revise for you what we used to do in the sums on ALCAR model. In the ALCAR model sum, we have to find out the value of strategy, which is post-strategy value minus pre-strategy value. Pre-strategy, the firm is a no-growth firm, so pre-strategy value is simply NOPAT by KC. There is no problem with this at all. Post-strategy value, the firm is going to grow for 3-4 years. So this table plus formula. Table plus formula. Table, you have to calculate FCFF. When you do the table, say particulars, and in years 1, 2, 3, suppose 3 years growth is there, so you have to show the table for 4 years. 1, 2, 3, 4. There are some time pass items. Sales. They tell us sales will grow at what rate? It's time pass. You have to just show it. PBT, time pass, PAT. This is useful. PAT is actually no PAT because in such sums, debt is not there. What the sums which have come up till now. If in your sum in the exam, debt is there, you are not concerned with no PAT, you are concerned with no PAT. Understand? Since all the sums which have come in the exam, interest was not there, therefore I'm writing PAT because if interest is not there, PAT is no PAT. So these two things where time pass, these two things were not required, but they are written to get marks. You will also have to do them. And PAT is no PAT. Of course, in the 4th year, 3 years growth, 4th year you just have to copy the figures. The 3rd year's PAT is the 4th year's PAT. 3rd year sales, 4th year sales. Okay, that way. The 4th year is just being shown as an extra so that we can use it in that table plus formula, the formula portion. No PAT by KC. Now, where does the problem arise? Now you have to find out the depreciation, the capital expenditure, the change in working capital. Now, there is no issue with this. There is no issue with this. But the capital expenditure portion is found out as a balancing figure. You may get confused. You will think I have written capital employed. It's capital spending. Okay. It is computed as a balancing figure. How? You have change in fixed asset in the balance sheet, add depreciation. So you will prepare a forecasted balance sheet where you will find the change in fixed asset, add the depreciation. That's how you get the capital spending. They want you to show this, otherwise there was a shortcut way of straight away calculating net investment as change in capital employed, but they don't correct it that way. So depreciation, don't worry, clue will be there. Change in working capital easy, but the capital spending will be the change in the fixed asset in the balance sheet plus depreciation. So the balance sheet forecasting, you have to do balance sheet. So fixed assets, so you have to grow them year 1, 2, 3, 4. Current assets, you have to grow them. Okay, and then your equity. Okay, you have to grow it. And you may also have some current liability. Okay, so that way. So basically, when you grow the fixed asset, then the change in fixed asset is known from here, which I was talking about. The current asset and the current liability, CA minus CL is what? Working capital. So whatever working capital was there in the balance sheet, this one minus that is a change in working capital. That's easy. Depreciation, they will tell us the depreciation rate. So it's a very easy sum. Okay.
So question number 4 is on hedging via futures contract. So in this sum, we have Nitrogen Limited, a UK company. Okay, so remember the home currency is pound. You have to calculate everything in pound at the end. Nitrogen, a UK company, is in the process of negotiating an order amounting to 4 million euro with a large German retailer. So a UK company is exporting to Germany. So 4 million euro receivable on 6 months credit after 6 months. If successful, this will be the first time Nitrogen will be exporting to the highly competitive German market. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. Invoice the German firm in pound, so invoice in home currency. But the 4 million euro was given in euro, foreign currency. So invoice in pound using the current exchange rate, the spot rate, to calculate the invoice amount. Okay, so we'll use the spot rate to know how much to invoice. Which spot rates are bid or ask? See, depends. We are going to receive euro, that means we are going to sell euro, that means buy pound. So if euro is the base currency, I will look at the bid rate. But if pound is the base currency, I will look at the ask rate. Let me in fact look at it. So here the rate is given spot rate. It's given euro per pound. Can you see that? So pound is the base currency. We are selling euro, buying pound. So ask rate 1.1770. So for the first part, the answer will be 4 million divided by 1.1770. First part over. Alternative to invoice in euro, that means 4 million euro is going to come after 6 months. Use a foreign exchange rate to hedge the transaction risk. So the forward exchange rate is 1.1770 plus 0.0060. 1.1770 plus 0.0060. Okay, 1.1770 plus 0.0060. Now this has been solved wrongly by the institute. They have done 1.1770 plus 0.0055. That's wrong. It should be 1.1770 plus 0.0060. So sir, what should we do? If you remember the sum and the same sum comes, give 2 answers. Incorrect solution done in the past. Solutions, correct solution. Give both the answers. Okay, and if you are doing for the first time, obviously you will do it 1.1770 plus 0.0060. I remember earlier there used to be a situation wherein it was like some discount was given, 6-month forward discount, but low high was given, so there was a lot of confusion. Anyways, I'll stick to this sum. In this sum, we should do 1.1770 plus 0.0060. That's the forward rate. So 4 million divided by the forward rate. Third part. Invoice the German firm in euro. So 4 million euro is going to come. Use a sufficient 6-month sterling futures contract to hedge the transaction risk. Okay, so in futures hedging, if you remember my class, I had done the solution in 3 steps. Step 1, whether we are supposed to buy futures or sell futures. So let's check which futures are there. So we have pound futures over here. 62,500 is the lot size given. So we have pound futures. Even the futures price is euro 1.1760 per pound. So pound futures. So we are going to receive euro. We are afraid of euro falling, that is pound rising. Euro falling, that is pound rising. So we should buy pound futures. Step 1, buy pound futures F plus at 1.1760. Second step, how many contracts? So the answer is pound equivalent of 4 million euro at the futures price divided by lot size. Exposure by lot size. Exposure equivalent by lot size. So exposure equivalent 4 million euro divided by 1.1760, whatever we get, that divided by 62,500, rounded off. Okay, 4 million by 1.1760, whatever you get, that divided by lot size 62,500, round off. So that number of pound contracts we buy at 1.1760. Step 3, settlement. So spot rate and 6-month futures rate. So after 6 months, 2 different rates are not given. It's given the spot and futures, both are 1.1785. So first of all, square of futures. You bought futures at 1.1760. The futures price has gone up to 1.1785 and you bought futures. Good. So profit on futures is 1.1785 minus 1.1760. The whole multiplied by number of contracts into 62,500. Okay, 1.1785 minus 1.1760, whole multiplied by 62,500 into number of contracts. That is the amount of euro you gained. That euro plus 4 million. Add them up and sell it spot at 1.1785. The profit on futures plus 4 million divided by 1.1785 and you get the pound inflow. So you got the pound inflow under all the 3 options. In second question, they're asking which alternative should be proposed. The one which gives the highest answer. Okay, the one which gives the highest answer. So question number 2 of interest rate risk management is on the currency of borrowing and FRA pricing. There is a misprinting in the 3-month forward ask rate. You can see it's getting given 36%. But luckily the 3-month forward rate is of no use. So leave it. Okay, don't bother about it. It's given an Indian company obtains the following quote. Spot rate, 3-month forward rate, 6-month forward rate. Company needs dollar funds for 6 months. It's clearly given the company needs dollar funds for 6 months. Determine whether the company should borrow in dollar or rupee. Interest rates are 3 months, 6 months. Okay, also determine what should be the rate of interest after 3 months to make the company indifferent between 3-month borrowing and 6-month borrowing. In case of rupee borrowing, dollar borrowing. So the second part is FRA pricing. The first part is we have to borrow dollars for 6 months. So which currency should we borrow? Should we borrow in rupee or in dollars? Towards the end, it's given note for the purpose of calculation. You can take the units of dollar and rupee as 100 each. Very good. So that means they've given us the amount to be borrowed. How much? $100. So Alternative one, borrow $100. So if we borrow $100, the interest rate for 6 months is 5.5%. So how much do we have to repay after 6 months? $100 plus 5.5% of 100 into half, which is 102.75. Correct. So there will be an outflow of 102.75 after 6 months. So we cover it forward at 36.4. So 102.75 into 36.4. Use your calci. 102.75 into 36.4. Now that is coming to 3740.1. 3740.1. Alternative 2, let's borrow rupee. How much rupee? Since we required $100, so if we don't borrow $100, we will buy $100 from the market. If you don't borrow, you will buy, no? Because you need $100. At 36.1, you will buy. So you need 100 into 36.1, that is 3610 rupee. So amount borrowed will be 3610. Do not be confused. Why have you used the ask rate? We are thinking that we will borrow rupee and buy dollar. So to buy $100, you will require 100 into 36.1. That is 3610 rupees. We will borrow 3610 rupee at what rate? At the 6 month rupee interest rate of 11.5%. So the rupee outflow will be 3610 plus 11.5% of 3610 into half. That comes to around 3817.58. 3817. Over there we got 3740. So obviously dollar borrowing is cheaper. We recommend dollar borrowing. That's the first part of the answer. In the second part, we have to find out the 3 month interest rate after 3 months. So do you remember FRA pricing? Okay, the bigger periodic factor by the smaller periodic factor, the whole thing minus 1, the whole into 12 by gap. Bigger periodic factor by the smaller periodic factor, the whole thing minus 1, the whole into 12 by gap. So if you look at the dollar thing, the bigger periodic factor 5.5% will be 1 plus 0.055 by 2. And the smaller periodic factor 6% will be 1 plus 0.06 by 2 by 4. That means if you want it more precisely, 5.5% for 6 months is 2.75%. So the bigger periodic factor is 1.0275 and 6% for 3 months is 1.5%. So 1.015. So 1.0275 divided by 1.015, the whole thing minus 1, the whole into 12 by 3. 1.0275 divided by 1.015, the whole thing minus 1, the whole into 12 by 3 into 100. Okay, and you can calculate what it's coming to. 1.0275 divided by 1.015, the whole thing minus 1, the whole into 100 into 12 by 3. That's coming to 4.93%. Okay, annual 4.93%. The same thing you can do for rupee thing. For rupee, the 6 month interest rate is 11.5%. So that becomes periodic 11.5 by 2. That becomes periodic 11.5 by 2, which is 5.75. And 3 month interest rate for rupee is 12%. That is 12 by 3, 12 by 4 equal to 3%. So we have 5.75% and 3%. 1.0575 divided by 1.03. 1.0575 divided by 1.03. The whole thing minus 1. The whole into 12 by 3. The whole into 100. That comes to 10.68%. 10.68%. So this is very fast. You got to command figures, or you write and do hole na. What is the issue? It has been done in class beautifully. So when do we do the power thing? When do we do divide? In FRA, LIBOR is a simple interest rate. We always do divide. We never do power. In the bond chapter, where we play with 2 month, 2 year, 3 year, 4 year rates, there we do 1 plus something to the power 4 divided by 1 plus something to the power 3 minus 1. Okay. Question number 2. Now this is also a traditional sum on mutual fund, done in class, very nicely done in class. Then why am I doing it again? Because I consider the sum to be extremely important for the exam. So even if I have included it and I am discussing it, I am 100% sure there will be few students who might have missed out or who might have done it wrong. But as a result of my 5-7 minutes audio, they'll get it right. So I don't want to run the risk. So please bear with me. So this is the sum on missing figure. If you read the last line of the sum, calculate NAV on 31st March 17, 31st March 18, 31st March 19. I used to call them XYZ. Okay. Let's see. So on 1st July 2016, Mr. X invested 50,000 at initial offer in mutual fund of face value 10 each. So he got 5,000 units, 50,000 by 10. On 31st March 2017, that means 1st July 16 to 31st March 17, that's 9 months. A dividend was paid at 10%. So 10% of 10 is 1. So 1 into 5,000 is what? 5,000. And annualized yield was 120%. So annualized yield was 120%. That means the 9 month yield was what? 90%. You already know that this sum, okay, I'm assuming that you have done the sum once, and I will be, when I read the sum further, I will reiterate it, that this sum is on dividend reinvestment plan. That means the 5,000 units 5,000 dividend that we were supposed to get, 5,000 into 1, that was not received by us, that was reinvested by us, correct? So, we have a 90% return in the first 9 months. So, if you invest 50,000 and you earn 90%, how much do you earn? 45,000? Correct? If you invest 50,000, you earn 90%, you earn 45,000. Out of the 45,000, 5,000 is dividend. So, the remaining 40,000 is in the form of NAV appreciation, na? The remaining 40,000. Now the remaining 40,000 is on how many units? On 5,000 units. So the NAV appreciation is 40,000 divided by 5,000. NAV appreciation is 40,000 by 5,000 is what? 8. That means the NAV on 31st March 2017 is 18. 10 plus 8, 18. Hope you understood. 10 plus 8, 18. It's clear cut logic. So 18. And how many units did we get on this date? We got 5,000 divided by 18. The 5,000 dividend was reinvested, so 5,000 by 18, that is 277.78. Okay, we write it down so that we don't miss it out because I'm solving the sum verbally. So 277.78 plus 5,000. 277.78 plus 5,000, total number of units that we have is 5277.78. Okay, 5277.78. Now, let's proceed further. On 31st March 2018, that means 1 year later, 20% dividend and capital gain of 0.6 per unit was given. So 20% dividend is 2 and capital gain distribution is 0.6. The 2.6 is the distribution. So 2.6 multiplied by the cumulative units. 2.6 multiplied by the cumulative units, 5277, whatever the figure was. It's coming on my calci 13,722.22. Rupees 13,722.22 we should have received, but this 13,722.22, this was reinvested at the NAV on that day. Let's call it Y. So we don't know the Y. We don't know how many units we got. Let's read further. Mr. X redeemed all his 6271.98 units when his annualized yield was 71.5% over the period of the holding. Now, how did the units become 6271? That means the increase in the units, that is 6271.98 minus the cumulative units we had, 5277.78. The increase in units is 994.202 on my calci. Now, these extra units, 994.202, which you should write and save, these extra units were purchased from the dividend amount, the distribution amount, the 13,000 amount. So 13,000 something divided by the extra units. 13,000 something divided by the extra units is coming to 13.80. So 13.80 is Y. 13.80 is the NAV on 31st March. Okay, so I got two answers. 18 is the NAV on 31st March 17 and 13.80 is the NAV on 31st March 18. Okay. Now it's saying that we earned 71.5% over the period of the holding. 71.5% annualized yield over the period of the holding. Annualized. So 71.5% is annualized. Now what is the total return? See, our total horizon is 2 years and 9 months. Total horizon is 2 years and 9 months. That means 2.75 years. So if we do 71.5 into 2.75, 71.5 into 2.75, that is 196.625% return. So 196.625% return on 50,000. 196.625% return on 50,000. 196.625% return on 50,000 is coming to 1,48,312.5 is what we earned. 1,48,312.5 is what we earned. If we earned this amount, that means this plus 50,000. That means this plus 50,000 is the redemption value at the end. 198,312.5. So 198,312.5 should be the total value of the 6271.98 units. So let's divide by that. Divide by 6271.98. Divide by 6271.98. It comes to 31.61. I hope I'm not doing a mistake. Okay, I hope I'm not doing a mistake because I feel that I've done some mistake. The NAV initially, let's go down. The answer, I'm checking the answer. No, the last NAV is not matching. So let me just once again check where I've made a mistake. Let me go to the question and check where I made a mistake. Just 1 second. So the annualized yield was 71.5% over the period of the holding. Okay, let's try 71.5%. So I think I made some calculation mistake. Okay, because the process was correct. Let's do it again. 71.5% is the annualized yield. So my holding period is 2.75 years. 71.5 into 2.75. 71.5 into 2.75 is 196.625. So 196.625% of 50,000. 196.625% of 50,000 is 98,312.5. Yes. Now 98,312.5 plus 50,000 is 1,48,312.5. So this is the ending value. 1,48,312.5 divided by 6271.98. Divided by 6271.98. That's coming to 23.65. So 23.65 is the NAV on the last date. Okay. Once again, if I seem to have spoken fast, this sum has been done by us. You have to be able to solve the sum on rough in a speedy manner. Okay, because if you sit down to write and solve each and every sum, how will you be able to cover so many sums in SFM? Okay, so it is easy stuff. Of course, when you listen to somebody in fast calculations, you may sometimes miss out the stuff. So try it on your own end. Initially, it was very easy. 90% return on 50,000, 45,000, 5,000 gone, 40,000 by 5,000, 8 rupees appreciation to 18. Next also it was easy. The last one also it was easy, but it was more math. So numbers were thrown at you. So no change in this sum. Easy sum. Please do it right. Thank you. For question number 3, let me first of all revise the stuff with you. On the screen you can see that I have given a chart in which I have written RP minus RE. RP is the return earned by a fund manager and RE is the required rate of return as per security market line. That means RF plus RA minus RF into beta. So RP minus RE is the Jensen's alpha, that is the extra return that the fund manager has earned. This is called return from total selectivity. Now we split this into two parts. On the left side, we have RP minus RE as per CML. Now, you know CML, capital market line, is RF plus Sharpe ratio into SD. RF plus Sharpe ratio into SD. Sharpe ratio of whom? Sharpe ratio of the market. That means the slope is RM minus RF divided by sigma M. RM minus RF divided by sigma M. So it's RF plus Sharpe ratio into sigma P. So CML considers total risk while SML considers only systematic risk. So when you do RP minus CML, you get the return earned by the fund manager from skill. On the right hand side, you have the residual term, which is CML minus SML. Now this is the return he should have earned because of unsystematic risk. Okay, return from unsystematic risk. So Jensen alpha is split into two parts. The left part is called skill or net selectivity. Net selectivity. And the right side part is called return due to inadequate diversification or unsystematic risk. Okay, so this is the knowledge. But when we see the sum, question number 3, then you will find that in this sum, ICAI has done it wrong. When they were asked to calculate return from skill, they calculated Jensen's alpha, that means RP minus RE. And when they were asked to calculate return from unsystematic risk, they did RM minus RE. They compared the RE with RM. Now that's totally bullshit. So you have to remember the solution. You have to remember the solution. You have to mug up the solution. Okay, you have to remember that you have to mug up the solution. The solution is wrong. The first part is also wrong. The second part is also wrong. Next, we come to question number 4 of portfolio management. And that sum is on runs test. Look at the screen. Now runs test, so many times it has been done in class. I'll keep my discussion short. So in runs test, we check whether the market is weekly efficient or not. First of all, we mark when the prices have gone up, that is a plus. If the price has gone down, that's a minus. And a series of plus in the same direction or series of minus is called one run. So for example, 2800 to 2780 is a minus, 2780 to 2795 is a plus, 2795 to 2830 is a plus, 2830 to 2760 is a minus, and so on. So everybody knows that. So if you look further down, what's the question saying? With the help of the above data, evaluate the weak form of efficient market hypothesis by applying runs test at 5% and 10% level of significance. Now, you know that there is something called the T distribution. Okay, and T distribution, we have N1 plus N2 minus 1, that is 18 degrees of freedom, because N1 means number of pluses, N2 means number of minuses. So N1 plus N2 minus 1, from the question it's apparent that there would be 18 degrees of freedom because the value of T is given only at 18 degrees of freedom. Okay, so whatever test statistic R, okay, the R that we calculate, if it comes to be more than the critical value, that is 2.101 or 1.734, in that case market would be inefficient. Okay, let's check it out. So if you look at the solution, they have marked plus minus plus minus plus minus based on what I said, and then they counted the number of pluses, that's 11, number of minuses, that is 8. Okay, the number of runs, okay, that is 8. Number of runs is the number of series of positive and negative changes that we used to show by brackets. Then they calculated mu is equal to 2n1 n2 divided by n1 plus n2 plus 1. They got 10.26. SD, I don't like this formula which they've given. Our formula for SD was mu minus 1 into mu minus 2 divided by n1 plus n2 minus 1. Understood? That means 9.26 into 8.26 divided by 18, the whole square root. That comes to 2.006. So we have the mean, we have the SD. Okay, we have the mean, we have the SD. And we have the runs. Runs was what? 8. So we have to convert the 8 into T statistic, that is, we can do in two ways. One is R minus mu divided by standard deviation, or we can do it via the interval method. Let's see by which method they have done. So they have done by the interval method, that is mu minus T into standard deviation, mu plus T into standard deviation. So they got 5.932 and 14.588. So if R lies between these two, then market is efficient. Okay, but if R lies outside, in that case market is inefficient. So what was our R? The R that we got was 8, and 8 lies between 5.932 and 14.588. So the market is efficient. Similarly, at 10% significant, they got the lower limit, mu minus T into SD, mu plus T into SD, that's 6.688, 13.832. So accordingly, R lies, once again 8 lies in between. So market is efficient in the weak form as per runs test. I've done it fast because runs test is something that everybody knows. It's more of a revision. Okay.